Most people think the economy runs on money, like there's a fixed pile of cash somewhere that keeps everything moving. Picture this instead. You open your banking app and your transfer is stuck on pending. Then a friend texts that their card got declined. Within an hour, you see a photo of a line at an ATM, and suddenly, the question isn't interest rates or GDP. It's whether you can get your own money today. Notice what changed. Not the amount of money in the country, but what people believe will happen next. Modern economies run on confidence more than money, because confidence is the thing that coordinates millions of decisions that have to line up for normal life to feel normal. Confidence is expectations plus trust plus coordination, the quiet agreement that the rules will still work tomorrow. Money works because you expect other people to accept it, your employer to pay in it, and your landlord to want it next month. It's like traffic. The road is real, the cars are real, but the whole system depends on everyone believing the light will mean the same thing for everyone else. When that belief holds, you don't think about it at all. When it cracks, you can have the same roads and the same cars and still end up with a jam. Banks are the cleanest example because a bank can look fine on paper and still fail in a day. Your deposits aren't sitting in a vault with your name on them. The bank lends most of that money out, keeping only a slice ready for withdrawals. If a few people want cash, no problem. But if everyone shows up at once, the bank runs out of ready money, even if its loans are good over time. That's why deposit insurance and central banks exist. They're confidence tools that tell people they don't need to sprint to the exit. In 2008, fear didn't wait for every loan to fail. Funding dried up because no one trusted the next institution in line. Markets work the same way, just faster, because prices are expectations about future profits, not a report card on today. A stock can drop hard without a single factory closing, simply because investors decide the future looks worse, and they all try to sell first. Then mechanics kick in. Margin calls force selling, falling prices trigger more selling, and the screen turns red for reasons that feel circular. That's why exchanges have circuit breakers, and why central bankers choose their words carefully in press conferences. Markets don't crash because a spreadsheet changed. They crash because everyone tries to exit at once. Inflation is where belief reaches into your grocery cart. If you expect prices to be higher next month, you buy earlier, you stock up, and you feel less patient about waiting for a sale. Workers push harder for raises because they don't want their paycheck shrinking, and businesses raise prices sooner because they expect their costs to rise. That loop can turn a slow drift into a rush, even without a shortage on the shelf. Central bank credibility matters because it anchors expectations. Sometimes, a simple "we will keep inflation down" moves bond yields before any policy changes. Recessions often start as a confidence problem that becomes an income problem. Imagine a small business owner who hears customers are cutting back, so they pause hiring and delay a new oven, not because they're broke, but because they're unsure. Multiply that caution across households delaying a car, firms freezing projects, and banks tightening lending, and demand falls in a way that makes the worries come true. Economists call the emotional side of this animal spirits, meaning the gut-level willingness to take a risk. You can measure the temperature indirectly in consumer sentiment surveys, credit spreads, or volatility indexes. But the mechanism is simple. Fear changes behavior, behavior changes outcomes. Government debt and fiat currency also rest on trust, just at a larger scale. A currency holds value because people believe the government will keep collecting taxes, enforcing contracts, and not printing recklessly to cover every problem. When that belief weakens, people rush to convert savings into something else, and the rush itself pushes the currency down. The point isn't that confidence is fake. It's that it's an input. like electricity in a data center, and you notice it most when it flickers. If you've seen a moment where belief became reality, like a shortage, a price spike, or a sudden panic, leave it in the comments, and subscribe if you want more macro explained in plain language. The economy is a machine made of people, and people run on confidence.